When crude is back above $100 and AI is powering record earnings, portfolios are being pulled between boom and energy shock. You're watching vTalkInsight, Allocator's Lens Daily for May 4th, 2026. Let's start with how equities are navigating this tension between extraordinary profit growth and rising macro risk. In equities, the dominant story is still an AI and earnings-driven surge that is outrunning the macro headwinds. Major U.S. indices have recently pushed to new highs, powered by exceptional profit growth in technology, energy, and select cyclical sectors. For portfolios, that strength is both an opportunity and a growing source of concentration risk. Earnings season has been remarkably strong. Only around 1 in 8 companies has missed expectations, the lowest miss rate in several years. S&P 500 earnings growth estimates have been revised sharply higher, from the mid-teens to close to 20%, and actual growth is tracking even better for many large-cap names. A big part of that upgrade comes from AI and cloud. Hyperscale providers are reporting roughly $1.5 trillion of contracted but not yet recognized revenue, and plan around $700 billion of capital spending on AI infrastructure this year. That spending is driving powerful demand for chips, data centers, and power. Semiconductor stocks sit at the center of this trade. Chip makers have rallied on the order of almost 40% in a single month, far outpacing broader indices, and infrastructure suppliers are expected to enjoy tight capacity and strong margins for the next several years. Retail flows into leveraged semiconductor funds underline how stretched the positioning has become. Risk appetite is not limited to megacap technology. An index tracking in profitable but improving companies has broken to all-time highs, and strong trading profits at major U.S. banks are fueling expectations of sizable share buyback announcements later in the year. At the same time, energy majors such as Chevron and Exxon have delivered solid earnings beats as higher crude prices offset conflict-related outages. Yet this impressive earnings picture sits alongside clear signs of fragility. Market leadership is narrow, with a small group of U.S. tech giants and a few cyclical sectors doing much of the work while the median S&P stock remains well below its peak, and UK banks are dragging on the FTSE even after reporting decent results. That concentration has led some allocators to treat a select group of 6 U.S. platform companies, excluding Tesla, almost as quasi-defensive holdings against broader equity and bond risk. Macro data are also flashing amber. Real consumer spending slipped in March as inflation eroded purchasing power. The household savings rate has fallen back toward post-pandemic lows, and U.S. consumption growth is slowing even as investment remains heavily skewed toward AI-related sectors. If oil prices stay above $100 to $120 for several months, or if global benchmark yields break decisively above 5%, equity valuations could face a tougher regime. For now, the base case is still expansion with recession odds around 30%, but many managers are watching for triggers to de-risk, such as a sharp spike in oil toward $150 to $200 or a meaningful earnings disappointment from an AI bellwether. In rates, the same energy shock that is boosting parts of the equity market is complicating the inflation outlook. Oil above $100 has pushed headline inflation higher again, even as recent growth data in the U.S. and Europe soften, raising concerns about a return of stagflation rather than a clean soft landing. Central banks are leaning more hawkish than markets had hoped. The latest Federal Reserve meeting saw multiple dissents, with some officials arguing that an easing bias is inappropriate given broad-based inflation and upside risks from higher oil prices. Several policymakers have pushed back against expectations for imminent cuts, and now describe the next move as potentially either a hike or a cut, depending on how inflation and the conflict evolve. In Europe, the European Central Bank stands out as the most inclined to tighten. Officials are signaling that rate increases from June are on the table if inflation risks persist, despite survey and lending data pointing to a fragile Eurozone economy. That raises the risk of a policy error if higher rates hit already weak activity. The Bank of England faces a different dilemma. Markets price several additional hikes, but officials suggest that only a renewed surge in energy or wage inflation would justify further tightening from already restrictive levels. Yields have adjusted accordingly. Bond yields in the UK and Germany are at multi-year highs, reflecting worries about the prolonged closure of the Strait of Hormuz and its impact on both inflation and growth. Yet U.S. Treasuries have outperformed other developed bond markets during the crisis, reinforcing their role as a preferred safe haven, and short-dated U.S. yields still look relatively attractive as a source of income if the Fed holds rates steady. Looking ahead, if oil stays high but below the extreme $150 to $200 scenario, central banks may feel forced to keep policy tight for longer. In contrast, a severe energy spike that tips economies toward recession could prompt a pivot to rate cuts, pulling long yields down and potentially restoring bonds as a more reliable offset to equity risk. In credit, surface conditions remain calm, but underlying stress is building. Public credit spreads are still tight by historical standards, and some managers expect only a gradual widening back toward 3-year averages if volatility picks up later in the year, rather than a sharp dislocation. The more complex picture is in private credit. A record number of private borrowers defaulted in the first quarter, especially among consumer-focused firms, and that has pushed U.S. private credit spreads wider by roughly 50 to 75 basis points. Relative to high-yield bonds, where spreads have actually tightened, private loans now look more attractively priced to many allocators, who expect the next vintage to come with tighter covenants and stronger lender protections. Importantly, this strain is not seen as a systemic threat. Private credit vehicles generally have locked up institutional capital and limited leverage, which reduces the risk of forced selling even as individual deals run into trouble. Institutional demand remains robust, with significant dry powder ready to deploy during market disruptions and a growing interest in structures that are secured on tangible assets. On the supply side, secular themes are reshaping the credit universe. Roughly $400 billion of AI-related financing has been issued since the middle of last year, mostly in investment grade, and large U.S. technology firms are diversifying issuance across regions to avoid overloading domestic credit indices. Asset-based lending, currently around $500 billion, is expected to grow rapidly against an addressable market estimated in the tens of trillions, as allocators seek more secured lending over unsecured alternatives. For portfolios, that all argues for focusing less on broad beta and more on issuer quality, sector exposure, and manager selection as higher policy rates and expensive energy increasingly separate resilient borrowers from those reliant on easy refinancing. In foreign exchange, the Japanese yen has become a focal point for how policy divergence and the energy shock feed into currencies. Authorities in Tokyo have intervened for the first time since 2024, reportedly spending around $34.5 billion to support the yen after it weakened toward 155 per dollar. The intervention triggered the sharpest yen rally in nearly 2 years, but did not change the underlying pressures. The Federal Reserve remains relatively hawkish. The Bank of Japan still runs very low or negative real rates, and Japan's energy import bill is rising as oil prices surge. Those forces continue to favor a weaker yen, and markets now see the 160 level in dollar yen as a potential line in the sand for further action, especially during holiday periods when liquidity is thin. Volatility has picked up as traders weigh the odds of additional interventions and the prospect of a genuine BOJ rate hike, which some expect could come as early as June. Many see sustained yen strength as unlikely without that shift in policy. There is even discussion that if Middle East tensions were to disrupt oil flows to Japan directly, U.S. authorities might join efforts to stabilize the currency, which would be a rare step. For cross-asset allocators, dollar-yen is now a key barometer of stress. Persistent weakness highlights how higher energy costs and rate differentials burden importers, while sudden spikes in yen strength can tighten global liquidity and unwind popular carry trades. In commodities, energy remains the hinge for the entire macro picture. The Strait of Hormuz is effectively closed, blocking key shipping lanes and preventing a large share of Persian Gulf exports from reaching the market. The U.S. blockade has removed more than 10 million barrels per day from global supply, with only around 6 to 6.5 million barrels rerouted through alternative pipelines. The gap between lost and rerouted barrels is being bridged by drawing down commercial inventories and strategic reserves. Those buffers have already been significantly reduced, leaving the system more exposed to further disruptions. Oil prices are above $100 and have risen about 25% in just 2 weeks. For now, stock draws and some early demand adjustment have kept a lid on an even larger spike, but the balance of risks still points to more upside and heightened volatility if the stalemate continues. Scenario analysis around energy is central for allocators. In a severe case where the strait remains closed and crude surges toward the $150 to $200 range, recession risks would rise sharply as fuel costs erode disposable income, particularly in Asia and Europe. Central banks might then pivot from focusing on inflation to cutting rates, which could support government bonds, but would likely be challenging for most risk assets. Even if a ceasefire arrives and prices fall, export bans, price caps, and depleted inventories may prevent a full retracement, leaving energy inflation uncomfortably high. Industrial metals and precious metals carry their own supply stories. Aluminium faces its largest deficit in decades, with a shortfall of around 2 million tons and limited spare capacity outside the Middle East, pushing prices toward $4,000 per ton for a period, unless a global downturn forces demand destruction back toward the 2,800 level. Copper supply is threatened by potential sulfur shortages in the Democratic Republic of Congo, which could disrupt a meaningful share of refined output if Middle East trade routes stay impaired, though expanded use of scrap in China offers some medium-term relief. Gold's upside has been capped by dollar strength, yet central bank demand remains strong, with first-quarter purchases above recent averages. That steady official buying, combined with energy-driven inflation and geopolitical tension, reinforces gold's role as a strategic hedge even if price gains are incremental rather than explosive. Stepping back, today's cross-asset landscape is defined by a powerful but fragile equilibrium. Equities, especially AI and energy-linked names, are delivering exceptional earnings and buyback support, while rates and currencies reflect the strain of higher oil, sticky inflation, and divergent central bank paths. Credit markets still look orderly on the surface, yet private credit and lower-quality borrowers are absorbing the first wave of stress from tighter financial conditions. In foreign exchange, yen volatility is signaling how sensitive policymakers are to the combination of an expensive dollar and costly energy imports. Commodities, led by crude and key industrial metals, remain the hinge. Their path will heavily influence whether the current mix of strong profits and rising input costs can persist, or whether growth and policy expectations need a more fundamental reset. For allocators, the practical focus now is on a few critical junctions: the durability of AI-driven earnings, the behavior of oil and refined products as inventories fall, the reaction of central banks if headline inflation stays high while growth slows, and the possibility that currency interventions foreshadow broader shifts in global liquidity. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.